Welcome to a new video on my channel. I hope you're doing fine. Today I want to give you a short introduction to the company e2open and also give you an update about their first quarter 2023 earnings. And without further ado, let's get into the video. So in case you don't know e2open is a company which is focused on the supply chain and also on the connectivity of the supply chain. They say they connect the supply chain platform to transform your business. And as you can see, it's a platform, so it's a service as a software. And they anticipate disruption and opportunities to help companies improve efficiency, reduce waste, and operate sustainably. So this is, in my opinion, pretty interesting, especially given the actual, the current times right now. So this might help a lot of companies, and therefore I think it's a very interesting company. That's also the reason why I just had a look into the company and also in the earnings. So to give you a little bit overview about the company, I jump into the initial investor presentation, which is from, I think, the end of 2020, October 2020. So over here, the mission of the company is to build the most comprehensive and capable end-to-end global supply chain software ecosystem, combining networks, data, and applications to deliver enduring customer value. It's a little bit bulky, however. I would summarize it that they have software to get together data and everything from the supply chain to help the companies improve their logistics. So this is my way of framing it. So if we jump over to the initial transaction overview, as you can see, enterprise price value was around 2.5 billion, and they had quite some cash, which they used to pay down debt and also pay out the existing owners. But this is, I think, most important right now because there have been a lot of redemptions lately. This was not the case by then. So they had quite some cash back to the balance sheet or to pay down debt. If you go over to the part which I mentioned before, so they call it white space, which is on the one hand homegrown solutions, on the other hand manual and Excel based solutions, which is, as I understand it, up for grabs and could be all managed better with this software as a service as they offer. And this is a huge part of the whole TAM, and therefore I think there is a lot of growth which might be coming in the future. Why is it in general important that they have a better overview about the supply chains, the companies? If you just compare how the manufacturing have been a few decades ago. So the iron ore came in for the Ford example, and the cars came out. So everything was in one place. And now there's a decentralization. The example of a Boeing 787, it's more complicated than a car, I guess. But in general, you can see the point. So there are more than 2 million parts, around 500 suppliers in around 10 countries. And this is a lot more complexity than it was before. So this is why supply chain management is essential, and especially right now when everything is everyone is talking about supply chain issues. So maybe you're now asking, if this is so important, why isn't everyone using it? And I think it's just due to the reason that there's a lot of different parts which have been grown by nature, and it's always hard to change the processes you have. They have some case studies of different companies where you can see inventory reductions, which leads to improvement in costs in general, since you don't need to have a lot of storage room or storage in general, and also the inventory is faster sold. So this is generally a good time. Also improvement in forecast accuracy. So this is definitely very important, since then you don't have that long lead times and everything like this improves in general. And so this is something to keep in mind, and this is the reason why I think this company might be used a lot more in the future, or their software. And the last slide I want to show you from the initial investor presentation is the revenue and their projections. As you can see over here, it's had some significant growth in the years, even though in 2020 and 2021, or at least this is what is expected. And this is always a good sign in my opinion. However, the growth rate is not so astronomically high, at least what they expect as from some other companies. Therefore, I think the estimates are a little bit more conservative. And they guided to around 335 million in 2021 and around 367 in 2022. So since these have been projected numbers, real numbers have been 338 million for 2021, so a little bit higher, and 372 for fiscal year 2022. So they've been exceeding their projections slightly, so this is generally a good sign. And if we jump now over to their guidance for the year 2023, they guided to around 681 to 689 million of total revenue. However, this is a little bit higher as initially planned, because they have been buying some companies. They guide to around 10 to 12% long-term growth rate. This is right now in line with their long-term growth rate. Something to point out is their net retention rate, which they intend to increase even further. So they are right now, they are around above 100%, over 100%, and it should increase. So this is in general a good sign. Now let's jump to the first quarter of 2023 earnings. And they highlighted some business activities. On the one hand, the expansion of partnership with Uber Freight, which in my opinion is always a good sign, since this means Uber Freight in this case is happy with the partnership, and yeah, this helps to grow the company in general. The same for the strategic partnership with Accenture, which has also been expanded, and the company also has been positioned as leader with the highest ability to execute and furthest completeness of vision in the 2022 Gartner Magic Quadrant for Multi-Enterprise Supply Chain Business Networks report. And this is the third consecutive year which they have been the leader. So this is always a good sign. So the earnings are a little bit hard to analyze, because they did some acquisitions, 2 different acquisitions. The one was the BluJay acquisition. Influences, however, for me it's hard to really digest these numbers and make sense of it. So I'm looking for the next earnings review, how the development has been. And the company here highlights that there are headwinds due to the foreign exchange rates, and this will then lead to a reduction in the forecast. However, these are only due to the foreign exchange rate fluctuations, and there's no change to their guidance based on a constant currency basis. This is on the one hand for the subscription revenue, on the other hand also for the total GAAP revenues. And then also this will lead to, I think, a lower gross profit. However, their adjusted EBITDA will be the same as they mentioned over here. Well, this is what they expect. So now let's look a little bit at their projections. As I mentioned before, the 681 to 689 millions to be revised due to the foreign exchange rates. And over here I listed the different earnings developments after Q4 2022, because this is the first quarter where the 2 acquisitions have been fully contributing to the results. So as you can see over here, the subscriptions have been rising slightly, and the same for the professional services. However, not as fast as the subscriptions. The total revenue also is increasing, so this is a good sign. And as you can see over here, maybe bad from the visibility, the total cost of revenue is increasing less than 10%. So this is, in my opinion, a good sign. If the cost of revenue is rising slower than the total revenue. So this means there is an increase in the margins. And also, as you can see, the profit, or in this case the loss from operation, has been lower. So it's now 12.6 million, where it has been 23.2 million. So this is always a good sign to see that the operation is improving. That's a bit less detail, as you can see. And yeah, I think this is most of it. One thing to always have a look at is the cash and cash equivalents. As you can see, they went down around 26 million, but it's still quite some money left. However, keep this in mind for potential dilution. And the total current assets have also been reducing around 50 million, 53 million. The total assets have been stable, and also the total stockholders equity has been almost stable. So this is, in my opinion, generally a good sign. Oh, it's better if it's rising. However, could be worse. And down here you see cash equivalents and restricted cash at the end of the period, also going down. We're still with a net loss of around 12.6 million. It's still, in my opinion, enough money left. However, something to keep in mind for the future. So this leads me to the last point, what I'm focusing on in the future. The first one is the net retention rate, which is always a good sign if it improves, because this is a sign that the company or the software the company provides is good and is also used more than before from the different companies. It's always a good sign. The next part is the operational profitability. So maybe due to the merger and acquisitions and the synergies, there might have been improvements, and I hope that the company will be at least positive from the operational side in Q2 or Q3 2023. Also, something to keep in mind is the cash and the cash equivalent, to see if they might need to raise further additional capital. And then I would really be interesting to see the path to overall profitability, because they're always talking about adjusted EBITDA, however not on free cash flow or general profit in the general company. So this is something I will be looking into in the future, if there is the path. They don't have to be profitable by next year, but at least in the next 2 to 3 years there should be the path to profitability, at least in my opinion. So what do you think about the company? Would be interesting to hear what you think, and hope you enjoyed the video. Until next time, have a good day. Bye bye.